All right, what's up, traders? Welcome to today's analysis. This is currently 11, not 11, 1 11 a.m. my time, and let me confirm the audio. Okay, so it's 1 11 a.m. my time, and I've got like a bunch of like 1, 2, 3, 4, 5, 6, 7, 8, 9 notes on my table. So yeah, I was doing a little bit of study. I slept throughout today, which is why I did not really release any content. And so, just heads up. And this is me just getting down into doing some content for you guys because I was going through some of my study journals and I was taking down some notes for my new program, which is Darwin. Again, Darwin is not available to anyone. It's not available to the public. It's not. It's just my own personal thing. So you're going to, and that's why I'm teaching all of these things. So you can then use that to create your own protocol. You don't necessarily need to have my exact protocol. And that's why things like Twitter are usually generic because then it's your job to find out which works for you and then incorporate that into your own model and use that as a work model to build wealth for yourself. So not necessarily you need my own exact model. Excuse me. Not necessarily you need my own exact model to be profitable. Right. So again, it could be simple order block, optimal entry level, New York session or London session looking for your AMD setup. That's your power of three, and that's all you need to make profits. Again, it's your and that's why I keep telling you guys that you need to study more because it's your job to find out what sits well with you and what you're comfortable with when it comes to speculating in the markets. Out of all of these knowledge I'm giving out in all of these videos, find out what works for you and then adopt that into your own model and see if it works. Because initially, I was never comfortable with trading a an institutional financial job. I was never comfortable, and I always said to myself, I'm not going to trade that model. I don't like that model. I was never comfortable using BPRs as balance price ranges as entry levels or entry techniques. I was never comfortable doing that. I was always like, nah, this is not for me. So I'll just stick with my order block. And then as I got used to doing it by back testing and looking at the structure and seeing how we kept repeating, then getting comfortable, it's now one of my favorite setups. Okay, a lot of my setups are usually institutional entry drills or they are balanced price ranges. Once or twice I use other blocks, of course, but a lot of times you're usually institutional financial jobs, right? So again, it just came about by me learning to be comfortable using that. And if it's not something you're not comfortable with, then by all means, don't employ in your analysis. If you're not comfortable using balance price ranges, don't use balance price ranges. If you're not comfortable using other blocks and you just like your breaker blocks and that's the only thing you trade, by all means, then trade your breaker block. Wait until price create the scenario that you love that you used to and then speculate on that. But a lot of you guys are losing money. You're losing money because you're trying you're trying to trade the way I trade, or you're trying to do something you're not comfortable with doing, and you're trying to do something that you're not supposed to be doing. Okay, you're not comfortable doing those type of things. Okay, so that is a problem, right? So if you're not comfortable using institutional auto-entry drill, but you're seeing Nick or someone else using institutional auto-entry drill, you don't need to do that. Stick with what you're comfortable with because that is what's going to give you the return. It all goes back to the 80-20 principle. 80% of your results, 80% of your profits in trading is going to come from 20% of the same activity you're doing. So it's your job to figure out what are those things that keep repeating over and over again that gives me the money, and how can I just keep doing those same things. And then you leave the new entry styles and stuff to back test it. Okay, you back test, see the outcome before you then incorporate that into your model. So that was just a word of advice for you guys as students in the group. Today I'm going to talk about premium market versus current chart market. I've not really talked about this in depth. I used to teach this. For those of you guys who are in SMT, they are now a part of our team. I used to teach this like a year ago on S&T. I used to talk about this a lot. So I was more of a fundamental trader. I knew a lot about fundamentals. Now I was more, and those were my strong point in institutional analysis. For those of you guys who've been with me for like a year, you know, I used to teach COT, and I would teach open interest, and I would teach yield and bonds and all of those stuff. And it was I spent about a year learning all those things and incorporating them into a model. Now I teach more advanced stuff like technicals and how the algo books price and stuff. Anyways, so yeah, oil. I wanted to talk about this very bullish move in oil. Now, the first thing you want to, it's important to understand oil is if you look at the price of oil from August going into right now, you can see that oil is clearly in a very bullish market. Now, if you look at the DXY, it's also in a bullish market by the looks of it. Right, from August going into now, it looks like it's in a bullish market, but it's actually not in a bullish market. Why is this not in a bullish market? Because if you go all the way out on the DXY, you can see we have a large trading range from this side to this low. That this side was created September 2020, essentially a year ago. The low was created at the beginning of the year. We've been trading inside this range for a long time now. So on the macro time frame, the DXY is sideways. The DXY is neither bullish nor bearish. It's only sideways on the market time frame. So it's important to make this distinction when it comes to analysis of the DXY. All right. Now, if you look at this move, and compare this move with, let's say, something like this, lethargic, one-sided movement, this lethargic, one-sided movement, one-sided movement, one-sided movement. But now what you have here is outside this, where we have real volatility in price, we don't have similar volatility in price. It's just slowly, steadily grinding higher and running out stops and grinding higher and then running out stops and getting grinding higher. And we could also be running out stops potentially even inside of this. Or it could even be a reversal. Oh no. Okay, so what you're seeing here is characteristic of a relatively bullish market. So this is not a strong bullish market. It's a relatively bullish market on a shorter frame of mind. So let's say on a quarterly basis, this is a relatively bullish market. Okay, on a macro basis, it's a sideways market because we've been stuck within this side and this side. Now, by using the relative strength and then comparing that with oil, which is our topic of discussion. Again, remember the topic is premium versus discount market. Now, it makes sense now that oil can rally even though it looks like the XY is bullish because the XY is not truly bullish. The XY is more of a sideways market or a relatively or slightly bullish market. So that's why we can expect stuff like this from oil. Now, oil is a commodity, okay? And with commodities, what I'm about to teach you guys with commodities does not apply to currencies, okay? It only applies to commodities. So if you go to your bar chart, you can see commodities are gold, silver, platinum, ethanol, rough rice, oats, black cattle, pork. Um, these are all commodities, including the bonds. So you can also use this in bonds. So we can use this in commodities because now commodities as a factor of true supply and demand. Okay, so I don't mean supply and demand in terms of you're looking at candlesticks and on your charts. I mean real world application supply demand. Okay, just for example, let me pick any of these commodities. Let's say we have oats, for example. There's mass producers of oats and they're just mass users, commercial users of oats. The oats you guys take that are being manufactured on your shelves. I don't know why I took the notes, my bad. But the oats you guys take that essentially get on your shelves, they are sourced from the farmers that mass produce oats. Okay, which also makes up commercials. These are a part of the commercials. Okay, and also so we have commercials when it comes to commodities, okay, and the commercials are essentially the storehouse, or they are the regulators of the price of that asset, okay, because they are the ones that deal in the real world supply and demand of that commodity, like oats, for example, just large companies that require oats, and for them to purchase oats, they need a regulated price. Okay, and then obviously this relationship between commercial users and then commercial suppliers uh, creates the environment for regular large speculators to speculate the prices. Okay, but the prices are set based on real economic factors in terms of supply and demand by the relationship between the commercial users and the commercial suppliers. So the commercials in a commodity, they're divided into commercial users and then commercial suppliers, and they set the currencies. Sorry, they set the value or the prices of the assets. Okay, and then obviously we can get small speculators like retail, small brokerage firms, small hedge funds, and then large speculators like bigger banks that can speculate these prices. So now, typically in a commodity, we have what we call current chart market and then a premium market. So a current chart market is a regular market you typically would see in commodities. Let's look at oats, for example. So I'll explain to you guys what a current chart market is. So, all right, I need to find something that elicits. All right. All the commodities are building in massive premium, which is why I believe the XY is going to be potential bearish. Talk about that on the later call. I'm looking for a commodity with a current chart market. Let's see. This it's the premium market. Just looking at this. This is killing odds. A lot of the commodities sure they have premiums. All right, so what we are seeing here in the lean hog market is what we want to see, which is a current chart market. So a current chart market, when you go to your bar chart, you're looking at this contract. This is the contract number of contracts available for that asset. That is what this delineates. That is last. Okay, so this last delineates the number of contract for that contract month. Okay. So you can see this 84 point, sorry, the 73.32 is the number of contract for the December contract month on lean August. Okay, so you don't want to use the cash price. Okay, we're not dealing with cash, we're dealing with the futures. So whenever you select a commodity, ignore the cash price and go to the most recent month. Okay, the cash price, you don't need the cash price, you need the contract month. Okay, because each contract month in a commodity has an expiry date, and anyone who's speculating is forced to deal with that expiration of the contract month. All right, so a current chart market, excuse me, a current chart market has increasing contract month, increasing contract sizes in future contract months. So you don't need to see for the next 5, 6, 7 months. Okay, just for the next minimum of 2 months or 3 months. Okay, if the number of contracts increasing, just like you can see here. The upcoming contract month, which is December contract month, is 73.325. February is increasing 76.62. April, which is the subsequent contract month after February, is 80.875. So you can see it's increasing, which is the way it's supposed to be. So what does that mean for a carrying chart market? A carrying chart market is supposed to be is typical of price where we can see lower prices. Okay, in a carrying chart market. Okay, so this is when the delivery months are subsequently increasing. That is what creates a carrying charge market. And we then have a premium market. Okay, a premium market is what leads to what I call a commercial bull market, which is why I have a chart of oil, and which is why I've always said I want to see oil trade up into 85.8. Now, I still believe we could trade through this. I just want to see what we do around that level. Now, a commercial bull market is a result of a premium market. Now, remember, I just talked about a current chart market, and a current chart market is when we have the subsequent contract months increasing in value. Okay, it does not need to be 5 or 6 delivery contract months out. As long as it's a minimum of 2 or 3, it's fine. But here we have the next 1, 2, 3, 4, 5, 6, okay, contract months increasing in value. That's a typical current chart market. Now let's talk about a premium market, and this is where we go to uh, oil. Okay, so I'm just going to stick with oil. Let's stick with oil. Now, a premium market is a market where we have decreasing value in subsequent delivery months. Okay, when the value in subsequent delivery months is decreasing, this is where we have a premium market, which can often result in a commercial bull market. Okay, so now let's talk about premium markets. Okay, why is this important to us as traders, and why does this lead to a commercial bull market? The free market simply means that there's a very massive demand for that commodity now that the commercials they want to hold as much of that asset now because they're anticipating a more premium market in the future. So that simply means they're anticipating that market building a premium in the future. So this is where we get the term premium market. So remember, a premium market simply is a market that is oversold. Sorry, overbought, not oversold. Okay, an overbought market is typically a premium market. When I say premium, in a range that simply means something like this: when prices trading up into higher prices, that is a premium. Lower prices is a discount. Remember, it's basic terms, right? So when I say a premium market, that means simply means that there's an anticipation from the commercials that price is going to build in a premium in future market prices. And because of that anticipation, they want to hold as much of that uh, asset or commodity as possible now. They need the commodity now. And that's why you're seeing decreasing number in the in the number of contracts held in subsequent delivery months. So what you can see right now in oil, which is why I said I still believe this could really go up. I mean, really, this could really explode to the upside, especially with the factors we have. This could really get up back up into 108 to 110 level. We could see oil get back up into this. That is a very massive potential. Okay, 108 to 110 level, we could see oil get back up into that, especially what I believe is going to happen in the next few months globally. But we'll see about that. I don't want to get into any conspiracies. But yeah, so remember when we're here, and I mentioned that oil was going to get into 80 level, and if it gets there, the next level is going to be 85.89 to 88.05. That's the level we're going to see oil get into. That is because I was watching this as a premium market, okay, which means that for some reason because we have decreasing contracts in subsequent delivered months, that indicates to me that the commercials, okay, for some reason, they want a lot of oil now because they believe in the future is going to explode to the upside. That simply is a pure market. And that means this is as a result of them knowing something fundamentally that we are not aware of. So we're not privy to knowledge, of course, because we're not commercials. Okay, they are privy to knowledge and they know underlying something real world. Not, I mean, real world supply and demand. They have understanding that there maybe might be a shortage in supply or something. I don't know, but all this does is just reflect their biases and reflect their actions. Meaning They want a lot of the contract now. That's why you're seeing decreasing contract in subsequent delivery months because they want a lot of the contract now. They want it now, 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 because then they can then offset distribute their accumulated positions, okay, in a commercial bull market. And typically, a premium market is what leads to a commercial bull market because a premium market promotes a commercially sponsored bull run due to increased demand from the commercials, since the commercials are willing to have possession of a commodity as they believe there is going to be a short supply of that commodity. So, a commercial bull market, by definition, is a type of bull move that is parabolic and explosive in speed and quantity, unlike your typical bull market. Okay, which again, the current chart does not necessarily mean you're going to get a bearish market or a bullish market. It just simply means that's the normal way price is supposed to operate. It could be bullish, it could be bearish. It's That's how it's supposed to operate. But a commercial bull market only results from a premium market. Okay, and a commercial bull market is a hallmark of a premium market. So once we identify this, and then obviously you want to blend that with market structure, and that's why I went into the analysis of the XY first to let you understand that if this starts to decline on the XY has been slightly bullish. Remember, on the market time frame, still stuck within this range, so it's not impressive. If DXY starts to retrace and go below this candle and possibly even closing in this and trade lower into this, then we could really see oil gain momentum. Okay. Now, what oil has done so far is impressive. In the upside, is really really impressive. But if we see DXY start to retrace lower, oil could really really expand. I mean, it could do stuff like this, where it barely gives you a chance to get in. It just keeps expanding and expanding and expanding. So now, how would you visualize pre-market for this move that came in the month of August? Well, we go back and look at historical prices on oil. So by scrolling down, you can access the crude oil historical prices, and you can do the same thing for any commodity, especially if you're studying that commodity, studying this. So what I want to do is this bull market starts from August. So I want to look at the subsequent contract months leading to the month of August and see if there was a pre-market there. Okay, so I'm looking at subsequent contract months leading up to the month of August to see if we had any characteristic of a premium market there that would have sponsored a commercial bull run. So here you want to switch the year to you don't want to start from 1984 and start going down. So you want to change this rather than it starting from 1984 and then you're working your way up into 2021. Just switch this and from you can just scroll down easily and it's more accessible. It's more accessible and I'm going to the second page. And what we're looking for is we're looking for 2021 and we're looking for the month leading up to August futures contract month. And this is August futures contract month. And you can see the month leading up to August futures contract month, which is July. We have 73, okay, contract number there. And then the subsequent month, which is August going to September, we have declining changes in the contract months. Okay, so you can see July we have 73, August we have 67, September we have 62. Now October we jump 70, and then going into November we have the current trend market. But remember, the minimum we require for a pre-market is a number of uh, 2 months. Okay, two subsequent months of declining contract is enough for a premium market to then lead to a commercially sponsored bull market. So you can see from July going into September, we have a premium market with declining contract, and that is reflected in oil. So Obviously, from July, it's retracing down, going into August. We have a premium market being built in a price as price is trading into a discount. We're building in a premium. Okay, as we're trading it down to a discount, price was building in a premium. And remember, I talked about this relationship between the futures price of oil versus the cash price on oil. Now that divergence would have led you to find buys off of that move. So when market structure shifts to bullishness, when I talk about changes in discount here, where we have this breaker block, once market structure shifts to bullishness, you will start to anticipate a really explosive move to the upside because now we are in a commercial bull market. And when we're that commercial bull market, we want to see explosive moves like this. So what we have here is we trade down below the discount, we trade down to discount in this breaker block. We expand, trade back down into this bullish order block. Price expands, and we have a breaker here. Not actually a breaker. It's more like a pseudo breaker because we want to really break market structure of this old low. So we have a pseudo breaker here, breaker slash mitigation, whichever you want to utilize. It's all of these candles. It's one range. You can see below the discount. Once we trade up into that, we accumulate below the discount. Now watch out price never gets down into this bullish level. Okay, because a lot of people have anticipated price getting down into that bullish block for long, but we don't. We simply closing in the gap here. In the fair value gap there, we're closing in that. And then we should higher. And then we trade back down in this, and then we're just going higher. Major balance here. We expand, we come in and close in all of this inefficiency. Uh, this would have been kind of like a redeliver balance. And we come to closing on all of that. Uh, since the redeliver balance, because again, we have this where we have an inefficiency starting there. Then we have scanner trade up, trades back down, scanner trades up, trades back down, trades up, trades back down. All of this is redelivered by this candle. Okay, all of that is redelivered by this candle and this candle. It redelivers all of that. So we have a redelivery balance there, and we have that, and price trades down into consequent encouragement of redelivery balance. And we see price trade high through there. All right, so that is consequent encouragement of the redelivery balance. And the next level would be here to see that same level. I mentioned 85.89 to 88.05 would be the next level. I'm watching oil if we can reach up into that. So hopefully this lesson was insightful. If you have questions about that, ask me on Discord. I'll respond to your questions. With that being said, you guys will have a wonderful weekend, and I'll catch up with you guys tomorrow. Be safe.